With so many Islamic index funds out there, choosing the right one can get confusing, and selecting the wrong ones will cost you big time. So how do you know what's right for you and what information you need to make that decision? In the first of a series, I'm going to be going over 5 Islamic index funds, looking at what they offer, the cost, and how they compare to other Islamic index funds out there. Each one of those 5s is trying to give you something slightly different, so make sure you watch the whole video to see which one is right for you in your investing journey. But before I begin the video, make sure you do your own research. This is not financial advice. Investing is a long-term game where your capital can go up as well as down. So always do what's right for you in your personal circumstances. Okay, so the first Islamic index fund that I'm going to be looking at is the iShares MSCI USA Islamic ETF. If you're looking for this on investing platforms like Trading 212 or Robinhood, then you can find it under the ticker symbol ISDU if you want this in dollars, or under ISDW if you want to have this index fund in your portfolio under Great British Pounds. So this was the first Islamic ETF ever created all the way back in 2007, with its primary focus being concentrating on high growth companies. The split in terms of sectors it invests in, and this is actually going to be a common theme on all the indexes that you'll see today, as the majority in the tech sector, and companies, as you can probably tell in terms of the names, will almost entirely be US based. Next important factor to be aware of when looking at any index fund when it comes to investing for you personally is the expense ratio. And since this is the first index that we're looking at, we're going to be looking at a couple of definitions as well here. So an expense ratio measures how much you'll pay over the course of the year to own a fund, and it's expressed as a percent of your investment. So if you have $5,000 invested in an ETF with an expense of 0.04%, you'll pay the fund $2 annually. However, expense ratios aren't that small, especially for Islamic index funds. Now, the reason for that, and generally all Islamic finance products out there being slightly more expensive than the conventional products you can get, is due to the constant reviewing and potential reshuffling of the product. When it comes to the funds, the factors that the portfolio manager has to constantly be screening for are, first, if the industries that the company is involved in are Sharia-compliant, and there's 5 major groupings of them. However, arguably, what's more time-consuming for the portfolio managers is to make sure that all of the companies involved in that index fund are financially compliant according to Sharia principles. Now, I'm not going to be going into detail in this video, as I've already made an introduction to Islamic finance video, which I'll leave above me. But when it comes to investing and making sure what you're getting involved in is Sharia compliant, you have to ensure both that the industry and the financials are within the Sharia guidelines, as indicated by the main standard setting body, which is our fee. Okay, so with that explanation out of the way, the expense ratio here on this index is 0.3%. Is that good? Is that bad? Is that expensive? Well, it's okay, but numbers in isolation are meaningless. So as we move on and look at other index funds to invest in, we'll see what exactly 0.3% looks like in the wider market. We're moving on to the actual companies now in the index. Now, each index will have up to 100 or even more actually companies, which is good because the whole point of an index fund when it comes to investing and what an investor actually wants is diversification. And we're primarily going to be looking at the top 10 companies of each index here, as these companies are the ones that will primarily drive the index fund movements. So here's the top 10 holdings in this index fund, and immediately it doesn't look that great. Generally, I'd be happiest if the top 10 companies in the index fund are around 45 to 55%, so it's pushing on that limit. But having the highest weighting of a company making nearly 25% of the entire fund, meaning 1/4 of the fund is driven by one company, that just doesn't make sense to me. Of course, Microsoft is a great company, made solid gains over the past couple of years, and will definitely grow significantly over the coming years. But the whole point, if you go back a couple of seconds, of investing in index funds is diversification. 25% of the fund made by one company is not diversification in my mind. So understanding that, let's carry on looking at the other top 10 companies that drive this fund. You've got Microsoft, of course, then Tesla, ExxonMobil, P&G, Johnson & Johnson. I'm not going to hide the fact when I think this is supposed to be a high growth fund, these aren't the kind of companies that come to mind. P&G, ExxonMobil, Johnson & Johnson are more famous for just paying dividends than being growth companies, and that's why you do actually get dividends from this fund. But let's see the performance of this fund, and it's important to measure the performance of index funds against a benchmark, which is the primary comparison you should measure an ETF's performance against, with the benchmark being a similar group of companies this index is trying to copy. And you can see it doesn't really beat the benchmark. And when you annualize the returns since the fund was created, it's actually performed worse than the benchmark. Now, I'm not really surprised at that. When I saw the companies in the top 10, those aren't really the growth companies that I want to invest in. They're large, but slow growing companies and offer more stability than growth. Even when I look at what other companies are in the index, I see a little things which I'm not really happy with. I see First Solar, for example, one of the largest renewable energy companies in the world, but it's only got a measly 0.15% weighting. And I would rather have this a lot higher. So for me personally, where I see myself currently in my own investing journey, I'm interested in growth. And this is why I'm not really a big fan of this index in my portfolio as it currently stands. Next, we've got the SP funds, S&P 500 Sharia Industry Exclusions, or you can find it under the ticker symbol SPUS. So this fund was launched back in 2019. It's pretty new, and its benchmark, or the group of companies it's trying to copy, as you can probably guess, is the S&P 500, excluding the non-Sharia compliant stocks. And since the launch of SPUS, it's actually become a really big favorite for Muslim investors. Looking at the expense ratio, yes, it is higher, but there's a cost and benefit trade-off that always has to take place. So let's look at what SPUS is all about, and if this could be an investment that you're interested in doing. Diving into the companies and the performance over the past couple of years, if we start to look at the top 10 holdings, that's a little bit of an uncomfortable number for me. 58% is really pushing it when it comes to your top 10 companies, but numbers always need to be analyzed in what they're really showing. You can see, even though the top 10 holdings here of the previous index is lower, the split is so much more different for SPUS. Rather than having 25% representing the highest weighting for a company, here it's only 12%, and the remaining splits in the top 10 are very good. Now, these companies, we don't really need any introduction to them. Since the fund was created, they've driven massive gains over the past 4 years. And when people think of growth stocks, these are generally the stocks everyone talks about. But let's just take a step back here and address the elephant in the room. With what these companies are involved in, how Sharia compliant are they really? Well, I don't really have an answer to that. When it comes to finance, you need an objective measure. There's an objective measure of interest income, an objective measure of impermissible revenue, but there's no metric of involvement in questionable activities. And I know there is work going on behind the scenes, but until any standard setting body comes up with a criteria to say if a company does X or invests Y in another country, then it's going to be impossible to agree, because it'll be up to the opinion of individual portfolio managers to decide how questionable the companies are. Now, looking more on the performance, we see it didn't start off so great for SPUS. It went down a lot as soon as the fund began. But this is actually a really good lesson in investments being for the long term. The performance that you saw early on in 2020 was down to COVID. And if you stuck it out with this fund, you would have seen exceptional returns. In fact, its best 3-month period, as you can see, followed on from that large initial drop in value, meaning don't just panic sell for the sake of it. If you're into investing, especially around 2020, then this massive gain should have been no surprise, as almost every tech company was hitting record highs. The company and SPUS are probably also in the individual stock portfolios of many Muslim investors. These are just where the biggest gains have been in the past 2 years and will also be in the coming decade. If I have to say something bad about this fund, it's the obvious heavy tech bias. The top 10 companies only has, I'd say, 2 non-tech companies, and I'm being generous here as I'm including Tesla as a tech company. So that's why, even though I personally like this fund, I have other individual stocks in which I've invested which aren't tech firms to balance out my portfolio. Nevertheless, like I said, the coming decade is all about AI, and so these stocks are definitely going to be where the growth is going to be. And if anyone is worried about volatility or overexposure of this fund, looking outside the top 10 companies in the fund, there's some very safe ones included as well, such as the Home Depot, P&G, or even Abbott Laboratories, which, if you're unfamiliar with that last company, just know that there's only 4 companies that share 90% of the baby formula milk industry in America, and Abbott is one of them. So really, if it comes to me wanting growth stocks and I didn't really want to deal with picking individual companies one by one, I'd just invest in this ETF. I'd happily take that expense ratio as a cost of doing passive investing. Now, importantly, I will make this Google Sheets file available to everyone, and it's also going to be a living doc where I'll continuously be updating it with new funds and stats. If you want it before I decide to lock it, make sure you sign up to the upcoming newsletter to find out how to gain access. So before I carry on with the next fund, which actually has a very interesting name, I do want to say something, and this isn't me bad-mouthing any past content creators who've looked at index funds. You see, Islamic index funds are constantly changing like many other index funds out there, but more so than you'll find from the general public. You see, last year, there were massive changes in the companies included in various funds as they shifted to have a greater weighting towards more AI-heavy tech stocks. So if you have seen previous videos by other people which are perhaps over a year old, that is just something to remain aware of, that the information could be a little out of date. Okay, next we have Wahid Dow Jones Islamic World ETF. This is created, as you can guess, by the investing platform Wahid. I've actually made several videos of them already on my channel. But the fund stock ticker, which you'll find this on, is Ummah, UMMA, which is pretty cool. So this is actually a very new index fund, started in early 2022. The expense ratio is the first thing that had alarm bells for me, 0.65%. That's the highest we've seen so far, and in the context of the wider industry, it's actually pretty high. But let's have a look at if there's any good reason why it has to be so high. Now, one reason why this is so high is because it's a very actively managed fund, but it also gives you something different to the other funds we've looked at so far. So whilst it is a growth-focused fund, it focuses on growth portfolios, which for the majority are actually located outside of the United States. So immediately, one thing hopefully everyone should be thinking of is if this fund could give diversification away from those previous US-focused funds. Unfortunately, if you're in the UK, it's not currently available due to some regulations, but nevertheless, let's have a look at what Ummah Index Fund is all about. Sector-wise, it does focus a lot on tech, but it's not dominated by tech, which is good. Looking at the performance, it's not really doing anything for you as an investor. At best, it's on par with the benchmark, and to be honest, it doesn't even perform well against inflation. But I have to give credit where strength lies, and that strength is focusing on offering an Islamic index of high-growth non-US firms. And let's look at the companies it has in the index. It's got a good weighting towards Taiwan Semiconductor, TSMC. That's a super great company to be invested in, especially in my individual stock portfolio. I definitely have this company, so I'm happy to have that here. But overall, in terms of company mix, it's pretty basic. Its top 10 is just over 41%, which implies there's a big mix of companies of similar weightings throughout the index. In total, the index has around 100 companies, with most being big but slow growth companies such as Samsung. So would I even consider this as part of my portfolio? I actually would. Now, its company mix and high expense ratio is something that limits its involvement in my portfolio currently, but the fact I can get exposure to large non-US companies is a big plus. Mostly because having that diversification away from the US tech firms is, in my opinion, very important. Next, we've got an index which is continuing a similar theme in offering non-US companies, and that's iShares MSCI EM Islamic ETF, which you can find on trading platforms under the ticker of ISDE. Now, I'm going to be a little upfront here straight away. I don't really think highly of this fund. It started the same time as that first fund we looked at, ISDU, but this one focuses on emerging markets, mainly focusing on China, India, Brazil, and the Middle East. Let's just look at the data because I purposely wanted to show not all index funds are great, and it's actually possible to lose money. I'm starting with this unbelievable expense ratio of 0.85%. And then immediately, let's have a look at the annualized return since it started, which is, and that's not a typo, negative 0.33%, meaning over those past 10 years it's existed, you would have actually lost money. Now, the bigger picture here is when it comes to investing in any given year, of course, you can lose money, and that comes down to that basic, your capital can go up as well as down. But the underlying theory is the longer you hold your money in the index, you'll have positive returns. So it's shocking that over 10 years of holding this, you actually wouldn't have made any money. I can't sell this index fund to anyone. The only thing I'm going to add on here is if you look at the companies in index fund, you can see a lot of commodity-based companies, such as the ones involved in the oil sector. And commodities are heavily exposed to a lot of external factors that are outside of the control of the companies, which makes their returns very volatile. Volatility can give you high returns, but in this case, unfortunately, if you invested here thinking it was a great index fund to help you diversify your portfolio, it was a wrong call. The only plus I can think of here is it does pay a dividend, and commodity companies are known to pay decent dividends. Current dividend yield here is 2.2%, which is okay, but dividends aren't always guaranteed, so don't count on them. Now, the last one in this video is not an ETF, but a different type of fund I feel Muslim investors should consider when it comes to constructing a well-balanced portfolio. The name of this one is Franklin Global Sukuk Funds. The identifier for these types of funds are usually numbers. I've got the one listed here. So these funds are actually offering you fixed income, which is essentially a fixed return on an asset. In conventional finance, you would have bonds, but in Islamic finance, the equivalent product are sukuks. Now, I don't want to go into the details of what sukuks exactly are in this video, but the best way to think about it is that they're the Islamic financial equivalent to bonds. But bonds are going to be debt-based, whereas sukuks are asset-based, and that is actually why sukuks are Sharia compliant. The nature of bonds and sukuks, they're not to necessarily give you growth, but both of those products typically are used to give you some kind of stable, regular income. The dividend yield here has been 5.2% in the past, which is actually very good, but don't hold to that because dividends yields change all the time. The point here is that really this fund is all about stability. And so reviewing any charts is going to show a much lower increase in value versus those high growth funds we saw earlier. You can though look at the sukuks that the index has actually invested in. Those names generally will be unfamiliar to most people. However, what will stand out are the countries of origins of these sukuks. From the names, it's obvious, but the sukuks are mostly located in the Middle East, and the distribution of sukuks you'll usually find either will be in the Middle East, South Asia, or East Asia. Here, it just happens to be 100% from the Middle East. And when it comes to understanding this type of fund in more detail, it's about, like I said, stability. And once I'd say probably my 40s, I'd probably start thinking more about this. But right now, it's best for me at my current investing journey to be less than 7% of my portfolio due to me rather focusing on high growth funds rather than low growth stable income. But there's many other funds similar to this and the others that I've covered in this video, and I'm going to carry on reviewing them in upcoming videos. But investing can be tricky sometimes, and if you want a helping hand, investing platforms like Wahid are great to help you begin your investing journey. If you want to know more about that specific investing platform, then I've already made a couple of videos on them. I'll leave one of them next to me, so go check it out, and I'll see you all in the next video.